If price is what you pay and value is what you get, if the price is free, then what do you do? Hey, how's it going? Welcome back to my channel. This is Pradeep and you're watching Vlog of Note. In this video, I'm going to explain what is price to book ratio and to talk about two stocks which are practically free. Let's get started. So first of all, usual disclaimer here, I'm not a SEBI registered expert or a certified financial planner. If you want to make your own investments, you should do your own market research. I'm only talking about stocks that I personally own and have made a reasonable amount of money out of. There are different ways of valuing a stock. I can see you falling asleep, but basically at the outset, there are two broad ways. One is called absolute method and the other is called relative method. When you talk about absolute method, you value a stock for itself, absolutely as the company alone. When you talk about relative method, you value a stock in comparison to other stocks or companies in the same industry. Now, an absolute method example could be discounted cash flow. It's not as bad as it sounds. Basically, a dollar today is worth more than a dollar in the future. So if you take the future cash flows of a company, discount them back to the present value, you will arrive at the discounted cash flow value of a particular stock. Relative stock valuation examples include PE ratio or price to earnings and PS ratio in the case of companies that don't have earnings, that's price to sales. Anyway, if you take the PE ratio of a particular stock and compare it to another stock in the industry, at least you can start your research there. Now let's get into the video. First of all, let me talk about what is price to book ratio. Price to book ratio basically indicates the market price of a particular company divided by the book value of that stock price. Basically the assets minus the liabilities. If you take the PB ratio of a company and it's less than 1, it indicates that that stock is undervalued or that they have a low ROA or return on assets. If you take the PB ratio of a company and it's more than 1, it indicates that that stock is overvalued or they have a low ROE. PB ratios usually run contrary to something called the efficient markets theory, which indicates that if the price of a company is easy to find, then someone will definitely find it. Keeping that in mind, there is a list on screen now of companies in India in the Indian stock market which have PB ratios of less than 1, and lo and behold, there are two companies that I actually own. The first one is Steel Authority of India. If you live in this country, you're probably familiar with this company. It is a PSU and it's a really fast growing company. It is in fact one of the fastest growing PSUs in this country or public sector units. Basically, it is the largest producer of steel in this country and it's the 20th largest producer of steel in the world. It produces 16.3 million metric tons of steel every year and it's a sizable moat around this company. Anyway, if you take a look at this company's earnings for FY 2022, their earnings went up by 3x and their net income went up by 2x. Also, if you take a look at the stock price versus the earnings, over the last 3 years, their earnings has gone up by 87% and their stock price has only gone up by 12%. So clearly there's an opportunity here. Also, if you take a look at the median PB ratio, it's 0.65, indicating that this company is undervalued. The next company on my list is something that you might have heard of. It's called Cochin Shipyard. And I know this stock price has not done too well over the last 2 years. Anyway, Cochin Shipyard is India's largest shipbuilding and repair facility. Essentially, they control 25% of India's shipbuilding market and over 45% of India's ship repair market. If you have a ship in this country, chances are it was built by Cochin Shipyard. Anyway, Cochin Shipyard's earnings for 2022 are not too impressive. Their revenue only went up by 13%. However, over the last 3 years, their stock price has gone down by 4%, but their earnings has gone up by 4% every single year, indicating that there is an opportunity here. If you take a look at their PB ratio, it's at about 0.9 versus 1.9 for the industry. So this company is quite significantly undervalued. If you own any of these stocks, please do drop a comment down below. As always, please go over to YouTube, subscribe to the Vlog of Note channel, ring that notification bell so that you never miss a video, and I will see you guys in the next episode.